What are the Greeks and how do they impact commodity options? Imagine trying to predict how a roller coaster ride will feel without knowing how high it will go or how sharp the turns will be. That's similar to understanding how options prices change in the commodities market. Today, we're going to explore a set of tools called the Greeks that help investors see how different factors influence their options. These tools are like a map that shows how sensitive an option is to changes in the market. The Greeks include measures like delta, gamma, theta, vega, and rho. Delta tells you how much the price of an option will move if the underlying commodity price changes by $1. For example, if a call option has a delta of 0.5, it means the option's price will go up by about 50 cents if the commodity price increases by $1. Delta also gives a hint about the chance that the option will end up in the money at expiration. Call options have positive delta, meaning they gain value when prices go up, while put options have negative delta, losing value when prices rise. Gamma measures how quickly delta changes as the commodity price moves. If gamma is high, delta can shift rapidly, making the option's value more unpredictable. This is especially important for traders who want to manage risk as prices fluctuate. Theta is about time. It shows how much an option's value decreases each day as it gets closer to expiration. Since options lose extrinsic value over time, understanding theta helps traders know when their options might lose worth. Vega looks at volatility, which is how much the commodity price bounces around. When volatility increases, options tend to become more expensive because there's a higher chance of big price swings before expiration. Rho is less common but still useful. It measures how sensitive an option is to changes in interest rates. Longer-term options are more affected by interest rate shifts, which can influence their value. In commodity markets, these Greeks help investors decide when to buy or sell options. For example, delta helps gauge whether to buy options expecting prices to rise or fall. Gamma shows how risky it is to hold options during volatile periods. Theta warns about losing value as time passes, especially if the market isn't moving. Vega helps predict how market volatility might change the price of options, which is key in unpredictable commodity markets. Rho is more relevant for long-term contracts, where interest rates can impact the overall cost. Using these measures, traders can better understand their risks and potential rewards. They can adjust their positions based on how sensitive their options are to market changes. Keep in mind, these Greeks are based on current market conditions and can shift as prices, volatility, and time change. So, they're tools to guide your decisions, not guarantees of what will happen. Knowing how the Greeks work makes you a smarter investor in commodity options, helping you manage risk and spot opportunities more effectively.